Welcome back to FX Street. It's 9 a.m. Eastern. It's November 4th, Election Day, 2008. Welcome back, one and all. Great to see everyone here. It's an exciting day and a news-filled week. When I was putting this idea together to talk about fundamental analysis, our fundamental review as we're turning the corner on the rest of the year. Hello, Boyke. Hello, all my regulars, by the way. Great to see some new faces, too. I was thinking, well, it's always timely to talk about fundamental analysis, but sometimes there's not a lot to talk about. Well, that's not the case now. This week, we have a slew of economic numbers and 5 monster events. Yesterday, Reserve Bank of Australia cut rates more than expected. They were expected to cut rates by 0.5 percentage point, taking them down to 5.5%. They were at 6%. They cut by more than expected to 5.25%. That was last night. That was event number 1 of the week. Today, I don't think it's anybody's guess, elections in the U.S. That can certainly play a role in the markets. Thursday, we have the Bank of England, European Central Bank scheduled to meet, both expected to cut rates by 0.5% as well. Will the ECB cut more than 0.5%, like Australia did? And then Friday, as if that was not enough, so Thursday is events 3 and 4, meaning European Central Bank, Bank of England, and number 5 is Friday, that is non-farm payrolls. Expectation is horrible. I believe I remember seeing on the economic calendar, I can check for sure, we're in a loss of 189,000 jobs, I believe. It's very easy to find out though. So let's talk about these 5 big events and how it fits into our whole fundamental picture. And of course, we'll use the charts as visual aids. We're taking a look at an Aussie dollar 5-minute chart. Now, late last night in the U.S., U.S. hours, Reserve Bank of Australia met. Again, they're expected to cut rates from 6 to 5.5%. They cut greater than expected. Now, there's this very simple day trading strategy I like to use when big numbers are released, like a central bank meeting. We wait for 15 minutes and we draw white, or it doesn't have to be white, but horizontal lines at the bottom and the top of the trading range during the first 15 minutes. I believe the meeting was 11:30 p.m. Eastern, or 10:30 p.m. Eastern. So from 10:30 to 10:45, the market's going to be very, very wild. Goes down a lot, up a lot, down a lot, up a lot. It's very, very difficult to trade as soon as central banks release their decision. But we wait 15 minutes, wait for the market to cool off. I call it the cooling off period strategy. It's not important though. After it cools off, we can draw our lines after the first 15 minutes or 3 5-minute candlesticks, and we establish a support level at the bottom of that range, 66.41. 67.12 is a resistance. It's the low and the high of the market during the first 15 minutes. Now, the subsequent trade signal is generated when we break below support or above resistance. I like to wait for at least 3 more 5-minute candlesticks to close below support or above resistance. This strategy usually works out very well. We can apply it to a whole slew of different economic numbers. Now, my point in mentioning this is that the Reserve Bank of Australia cut rates more than expected. The market's initial reaction, which is this large red candlestick, was to the downside, as we expect. After all, the number one reason why foreign exchange currencies move, we know, the anticipation of higher or lower interest rates. Well, we anticipated 5.5% in Australia. The result was 5.25. So let's sell Aussies. Why not? Our Australian savings accounts are paying us a little bit less than we expected. Well, the market subsequently broke down. That we also expected. Why not? Let's sell some Aussie. We're getting less interest than we thought we were going to get. It was a really big surprise. They polled a number of analysts on Bloomberg. One guessed, or basically thought, that they would cut rates by a quarter. The rest of the analysts unanimously expected a 0.5 point cut. This was a shock to the market. Why is the Aussie dollar at 69.21 now? That is the question. We had a trading range of 66.42 to 67.12. We broke back inside the range, broke out with a strong candlestick, and never looked back. That breakout was at 67 and change. We're at 69 and change. That's a 200-pip rally in about 12 hours. Why is the Aussie so strong? You may say, well, maybe the dollar's selling off. Maybe it's just the Aussie is going up against the weak dollar, right? Well, I'll show you an Aussie yen chart. It's no different. Here's a 5-minute chart of the Aussie yen. That double bottom, I'm guessing, is also the double bottom that we saw in our Aussie dollar chart. It's very, very similar. Well, the Aussie yen, if we had broke out above this high of 66.32, which looks to be that initial reaction to the downside, from 66.32, we're at 68.73 right now, coming off a highs of 69 and change. Please let me know, by the way, if you cannot see the charts. I'll be happy to refresh them. But point being is that the Aussie is a lot stronger than we expected, a lot stronger logically than we would hope to expect. Maybe it was a case of buying the rumor, selling the news, where all the traders expected the Reserve Bank of Australia to cut rates. They did, and now those who sold short want to cover the shorts, and those who didn't buy yet will buy now. That still doesn't make sense in my book because they cut more than expected. Logically, if you were to ask me, I would say, hey, the Aussie is going to go down against the dollar, against the yen, virtually against everything, but it's strong. This really explains the new dynamic in the foreign exchange market, I would say in the past couple weeks, not even a couple weeks. This is a very new trend that's developed. Over the past few months, as we know, the Dow Jones Industrial Average, U.S. and European equity markets, really equity markets from all over the world, went down a lot. Unprecedented percentage and point moves. Some say the worst since the 1930s. When they went down, what went up? The dollar and the yen. The yen at 0.5%, whoops, I'm sorry, not 0.5% interest rate, now 0.3% of an interest rate of 1 percentage point. Bank of Japan cut rates just a little while ago. The U.S. dollar at 1% was at 1.5%, and analysts expect the U.S. to cut rates maybe another 25 basis points, 0.75 of a percentage point, maybe lower. But what do we have that's high yield? The Aussie, now at 5.25. The Kiwi, now at 6.5. The pound at 4.5. We're going to talk about the pound as well. It seems to have missed a party lately. I'll explain what I mean by that. But essentially, what's happened is over the summer months and coming into, well, just up until a couple weeks ago, when the equity markets went down, the low-yielding currencies that are considered to be safer currencies because they have lower yield, low risk, low reward, the yen and the dollar and also the Swissy have done very, 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 very well. What has suffered? Aussie, Kiwi, Euro, Pound, CAD, everything has been killed because they have higher rates. You know, say the Canadian dollar, 2.25% interest rates, that's still a lot more than 0.3% of a percentage point, 0.3 of a percentage point to the Japanese yen. So now that equity markets have reversed back to the upside, let's pick up the shot of the Dow Jones Industrial Average. As the Dow has gone down, 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 the yen and the dollar went up, up, up. Well, now, as the Dow and these other equity markets start to recover, why are we satisfied with 1% in the U.S.? We're not. Why would we be satisfied with 0.3 of a percentage point in Japan? We would not. Let's buy some higher yielding currencies. Things look a little bit better, a little more speculative. When things are scary, we buy low yield. When things are optimistic, we buy high yield. Well, things are quite optimistic. And the Aussie and the Kiwi have certainly been the recipients of a lot of this capital. And the question is, will this trend continue? Let's take another look at an Aussie dollar chart, longer term time frame now. Okay. Now, keep in mind, the Aussie dollar chart is essentially the Dow Jones Industrial Average. I'm going to put two charts together, see if we can make some sort of comparison. I know it's a little bit cloudy with all these economic lines, but if you look at, these are both daily charts now. On the top is the Dow Jones Industrial Average futures. On the bottom is the Aussie dollar pair. Now, the Aussie is not linked to the dollar, to the Dow. And the dollar, well, I would argue there's not a very strong correlation. But the correlation between optimism, pessimism does remain. Optimism, let's buy Aussies, sell dollars. Pessimism, when the market went down, 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 let's sell high yield, buy low yield. And that is the relationship that exists. And I'm sure if we had room in my chart for a 10-year bond chart, it would also show the same correlation. So now we can see the dollar, and it's miraculous. The lows that were hit, the lowest lows in the Aussie dollar I see are 60.08 on October 27th. The lowest low on the what did I say? What was the date on that? October 27th. Now the lowest low I see on the Dow Jones Industrial Average futures, 79, 78.96. That was on October 10th. Very big day on Friday, that October 10th. But we almost came down again, 79.44 and then 56 on the 26th and 27th. So as the Dow made a little bit of a higher low, the Aussie dollar made a little bit of a lower low. It's not perfect, but basically on October 27th, everything started to turn. You could have bought the Dow Jones Industrial Average futures at a low of 79.56. We're at 94.89 right now. That's almost 2,000 points, about 1,500 points. Now, you could have bought the Aussie down to 60 figure. We're at 69 now. That's 900 pips. So in about 1,500 points, 900 pips on the Aussie dollar. Not a bad correlation. And this is, I chose to start with the Aussie dollar because it really demonstrates the relationship in the market. Now the question is, let's go to Aussie dollar exclusively. Forget about the Dow for a moment. We just broke above a downtrending minor resistance line. We have a downtrending former major support line at 70.39, 70.50, and then a downtrending long-term resistance that we have not been in it for quite a while at 75.80. So all these yellow lines are just Fibonacci retracement projection levels. So point being is the Aussie dollar could find a place to make a major turn back down soon, or we could really continue, especially if we break above, I would say 70, 71 figure. That's not that far away, another 200 pips, and we're done. And then we go up, I think another 500 to 600 pips to the upside on the Aussie dollar, at least if this is not a real major market reversal. Who knows? To maintain the downtrending channel, we still have possibly 600 pips to the upside on the Aussie dollar. So we're not nearly at the point of being done. I don't think Dow Jones on the daily chart shows the same thing. Recent swing highs, we're up at 98.93 almost. I mean, that's a 50% Fibonacci retracement level drawn from the highs of 11,845. Those highs are, by the way, back on August 11th. Seems like years ago. It's also 50%, 50% Fibonacci levels, also a spike high over there, a swing high. So from 94.77 to 98, we have another 400 or 500 points on the Dow. We could possibly go up. Seems like a 2.5 to 1 or a 1.5 to 1 relationship between every point in the Dow and every pip on the Aussie dollar. Kind of funny how that works out. Means that as the Dow moves, the Aussie moves a little bit more, the Aussie dollar pair. So that is the Reserve Bank of Australia. Now, talking about interest rates, we have a lot of cuts that we've seen. Again, Bank of Japan has cut rates down to 0.3%. They were at 0.5 for a long time. Remember the Eurozone? They were at 4.25. We're at 3.75 now. The U.S., well, we know a couple of years ago we were up above 5%. We're at 1 now. Kiwi was in the 8s. Now we're at 6.5%. The U.K. was above 5, and we're 4.5%. CAD, I remember a day when CAD was 3-4% interest rates. Now we're 2.25, and the Swiss at 2.5. All interest rates have come down. They are expecting, again, this Thursday, European Central Bank and Bank of England to cut 0.5 point each. That would bring the Eurozone rates at 3.25. That would bring UK rates down to 4. So why are these currencies going up if we're cutting rates and we expect to continue to cut rates? Why is the Aussie and the Euro and the Kiwi? Here's the Euro dollar. I know it's kind of a messy chart. We have a major possibility of a head and shoulders forming on the Euro dollar chart. We may have some more room to go. Now, you may ask what these white horizontal lines on the charts represent. Very simply, they represent former support and resistance levels based on economic numbers. Remember we drew those two lines, the top and the bottom of the 15-minute range, based on the Reserve Bank of Australia meeting? Well, I've done that over the past month or so with every single major piece of economic news that either pertains to the euro or the dollar. Why do we do this? Because you may think I'm insane, but the market tends to treat these former support and resistance levels under important light in the future. What was support could still be support. What was resistance could still be resistance. Now, when the market hits an area on the chart where there's a lack of these white lines, it tends to move very quickly. It tends to gap down. We can see this most recently, 1-hour charts, as the market stayed in this trading range and then broke below Well, this was our former resistance from our Eurozone PMI numbers in October. We quickly broke down. But now we've come back inside this range. We've begun to slow down. It's a lot more evident on the 4-hour chart. And notice the entire trading range occurs between the cluster of white lines at the top with a swing high of 133, 132.97, and a swing low of 123.28 on October 28th. So, getting back to what we were saying, the question remains, if currencies are in a normal market condition, are supposed to move in the direction of higher rates or lower rates. If we expect lower rates in Australia, I expect Aussie to go down. Why is this opposite? Because now the economies, in my opinion at least, and the economies are in such bad shape. The U.S., European, Australian economies, the governor, I believe his name is Governor Stevens, Glenn Stevens, if I'm not mistaken, of Reserve Bank of Australia, said that officially Australia is in a technical recession, technically in a recession. And we've certainly heard the same kind of statements coming out of the Eurozone and the UK as well. The rate cuts, the stimulus plans, these billions, if not trillions of dollars of aid that have been given to the different countries, and especially the rate cuts, are considered to be medicine. This is my opinion. They're considered to be medicine. And the more medicine that our economy or any economy takes, the faster it will recover. And I think that is what's happening. Reserve Bank of Australia cut rates more than expected. It took more medicine than we expected to receive. Therefore, the turnaround in Australia is a little bit sooner. Imagine if the U.S. had not cut rates this whole time. Now you could say, well, the European Central Bank and Bank of England are really behind the curve from the U.S. In the U.S., they've been cutting rates for a long time. They've just kind of started over the past few months. So maybe we see, I think, if you were going to ask my opinion long term, I see a tremendous dollar rally in the future. As the U.S. maybe ideally one day will start to raise rates while these other economies are still cutting rates or at least not considering raising rates. All right, so that's event number one, is Reserve Bank of Australia. Event number two is the elections. Will a Democrat make the market go up? Will a Republican make the market go up? What will the market do the day after? What will the market do the next year? I've been listening to a lot of Bloomberg analysts that have stated that I believe the market tends to trade stronger under Democratic parties. It's not a political statement. It's just if you pick up any Trader's Almanac, they have these. I'm waiting for the New Year's before I get one. I'll get another one. But every year they publish a Trader's Almanac, and they tell you statistically after a presidential election, this happens. On this day, the market tends to do this, that, and the other. If you look at these Trader's Almanacs, I believe they'll tell you that under Democratic office, usually stock markets tend to do better. Now, of course, Republicans can make their own argument. That is true because of X, Y, Z. I'm not a politician. I couldn't care less. I'm a trader. I just want to know whether I should buy or sell. My opinion, I think if you to look at the Dow Jones Special Average on the U.S. equity side, I think in the years to come, the markets do well regardless. Not because there's a political ramification, but if you think of the markets as being elastic, especially the stock markets, especially the equity markets, a euro dollar can go from 160 to 110 to 190. It's different. This is a reflection of import, export, interest rate differentials. But if the euro goes from 120 to 160, sure, it affects those of us that are involved in companies with multi-currency implications, or those of us decide to take a vacation. But our savings accounts, our IRAs, our 401ks, our savings are in stock markets usually. So whether it's a FTSE, the DAX, or the Dow Jones Special Average, our 401ks in there. So there is that much more governmental intervention that is going to assure us that our 401k plans will be there in the future. So I think that's the difference between the stock markets and the foreign exchange markets, is that the markets will always go up. On the long term, I think the stock markets will always go up. Those analysts made a great comment the other day on Bloomberg last week. He said, a couple of weeks ago, when we were in the midst of really seeing the worst days in October, the analyst said, listen, the stock market has recovered from every market crash since the 1700s. And who's to say this is any different? 1974, looking back, was a great buying opportunity. 2001, well, not 2001, maybe 2003. 1987, of course. Those are great buying opportunities, and this, I don't think, is any different. Now, aside from my own opinion about the stock market, it's, I guess my only point being is that I think the stock market is very resilient, and it will surely recover because there's that much more interest. The dollar yen may go to 120, it may go to 85, it may go to 60. It can go to 150, who knows? And of course, Bank of Japan, other governments and central banks will intervene, but there's a lot more elasticity in the foreign exchange markets. The stock market is pictured like a rubber band. After it goes down a certain amount, eventually we know it's going to go back up. And that's why I believe, the stock markets obviously have a better chance to recover than maybe a trend in the euro-dollar pair. Now, the question always remains, who's going to fix the economy? What will it take? Politically, I have no idea. I'm not a politician. I'm not a political analyst. I really, to be honest, politics don't interest me very much, more than they pertain to the economy. I can make a very valid argument, and you can make a very valid argument in the opposite direction. So it's kind of fruitless. But what I will tell you is I truly, truly believe in technical analysis, and that eventually the market will find a reason to go up. The economy will find a reason to get better. Let's say, who knows, they're exploring ice particles on Mars, and this new technology that develops from NASA exploration will revolutionize the way. We can make any kind of argument that the low interest rate environment now will fix the economy. The stimulus plan, a Democrat in office, ice on Mars, whatever it may be, we won't know until the papers publish the headlines, but I can trust the charts. I know that technical analysis will show me double tops, double bottoms, reversals in trends, etc. Okay, so as far as who's going to, who will have a better effect to the stock market, I have absolutely no idea. What will the dollar do? Really, it's difficult to say. But what I would say is I'm sure over the next 12 hours after, once we start to receive news as far as who's going to win the election, there will be a trading range that will develop. Pay attention to this 12-hour, 24-hour trading range. The euro-dollar, for example, are in a trading range. After let the charts do the talking. They hit the nail on the head. I could not have said it better myself. After the trading range has developed, just the same way we plot the 15-minute strategy on an economic number like a non-farm payrolls, well, I think you can apply the same approach, but a little bit of a longer-term basis. Why? Because non-farm payrolls this Friday, the first Friday every month, 8:30 a.m. Eastern, the Federal Reserve presses a button and somebody releases the number. And we all know at almost the exact same time. The elections is a little bit messy because the polls are reported, or the voter results are reported over a period of time. We don't get the answer all at once. So we say, well, 5% margin, give or take, Arizona has voted this way, Nevada has voted that way. So it's a little bit of a more messy trade, so to speak. So I'm going to wait about 12 or 24 hours, pay attention to the market, what it does during that time. But I would say, especially coming into Friday, after the central bank meetings, I would say that the breakout next Sunday will be very, very important. Because I want the market to digest all of the news that we have received, all the minor economic news, factory orders today, 10 a.m. Eastern, I believe, in the U.S., all the way up to the non-farm payrolls on Friday, our central bank meetings, etc. We're giving the market a lot of information this week. The market needs time to digest it, sleep on it over the weekend. Traders going to wake up. Japanese market opens Sunday evening in the U.S. hours, and we're going to say, okay, based on all the fundamental events, I think the dollar goes here and the euro goes there, etc. So next week's breakouts, or the breakout after at least Sunday, I think will be a very, very, very important breakout to pay attention to. Okay, so Reserve Bank of Australia elections we've gone through. Thursday, European Central Bank and Bank of England are both scheduled to meet. They're both expected to cut rates by 0.5 percentage points. Now, let us take a look at, we run a poll to see what everyone thinks. Do we think they'll cut by 0.5%? I'm assuming the majority of those of us expect the European Central Bank and Bank of England to cut by 0.5%. If anybody believes otherwise, Please don't be shy. Type it in. I'm really curious to hear if there's an opinion out there, especially those of you that happen to live either in the UK or the European Union. What do you think will be the European Central Bank decision and the Bank of England decision? Again, their expectation is to cut by half a percentage point. Do you think that's enough? To those of you that live in the UK or the Eurozone, do you think there's more? I read an article on Bloomberg the other day. Spain is now officially in a recession, and I believe the worst figures since 1993, which certainly is not good. They've already seen this type of news out of Germany and France and a lot of the other Western European countries, and we know what has certainly happened outside that area as well. Thank goodness we don't have to talk about emerging markets like India and these other emerging markets that have been much, much more volatile. The stock market in India, stock market in Russia as well. But getting back to our majors, euro pound, we see the euro has been significantly stronger than the pound. Normally, you do not see the euro pound act in such a volatile manner. Now, almost never do you see an expanding triangle on a euro pound, at least from my experience. Expanding triangle, I should say, is typically known, if you look at the technical analysis books, they define it as a common reversal pattern. Normally, triangles are contracting. We connect these lower highs, and we connect the higher lows, and I can draw dozens and dozens of these patterns, and we can see normally a triangle is contracting. The support and resistance levels trend towards one another. This is more or less a symmetrical, an ascending triangle. But normally these lines approach one another. Why is it now that the current euro pound is showing us this expanding triangle, which is certainly not what we're used to? It's possible maybe the euro pound is in the process of mounting a major reversal. It kind of makes sense that it would, right? I mean, UK rates are higher than euro rates. So it's this euro pound trend is against a pretty strong carry trade. Euro rates are 375. UK rates at 4.5. If they both cut by 0.5%, we still have a 0.75 of a percentage point difference. That's kind of big. I guess my point being is this euro pound expanding triangle has made me very, very suspicious. Recent lows are near 7,700, recent highs near 8,200. This could be in the midst of a major market reversal. Now, of course, they say the trend's your friend, and the trend has certainly been to the upside, daily chart. But then again, I can draw uptrending support lines. I can make an argument, maybe not so much anymore. We've broken trend lines. So the European Central Bank, Bank of England, we will certainly see when that time comes. And of course, let me verify on my economic calendar here. But if that was not enough for today, we also have non-farm payrolls. That's on Friday. Non-farm payrolls, I think, really demonstrates how bad the job market has been in the U.S. side. Scrolling through my calendar here, and they say the real kiss of death, for lack of better words, is the fact that, wow, they changed expectations. Is that it's moved from a credit or a financial recession into a consumer recession. And that certainly is not good. Expectations on non-farm payrolls, the forecasts, I'm looking at Daily FX calendar, which I use a lot. The expectation was, I looked earlier this week, 2 days ago, I looked, it was 189,000 job loss. Last month was 159. They have raised expectations to a loss of 200,000 jobs. That is what's expected on Friday, a loss of 200,000 jobs in the U.S. The unemployment rate is expected to rise as well from 6.1 to 6.2%. Coincidentally, I don't really believe in coincidences, but Canadian unemployment is also expected to rise from 6.1 to 6.2%. Average hourly earnings stay the same. There's no real outliers aside from that. The non-farm payrolls expectation is a loss of 200,000 jobs. Is this a case? This recent dollar sell-off, are we expecting some bad news? Look at the dollar yen. You wouldn't know by looking at the dollar yen chart. We're at 99.36 right now. ascending triangle pattern. What's very, very interesting with the dollar yen, by the way, I have so many charts to show you. So, dollar yen 4-hour chart looks a lot like the Dow Jones Industrial Average 4-hour chart. The left-hand side of the column is the Dow Jones Industrial Average futures. Right-hand side is a dollar yen 4-hour chart. A year ago, there was a very strong correlation between the two. We can explain this correlation under normal market circumstances as an enormous amount of capital that comes out of a very low interest rate bearing Japanese yen moves into the US dollar in order to invest in US equities. Of course, you have to convert your Japanese yen into the US dollars to buy 10 shares of Apple stock or Microsoft stock. And that is certainly why when things look good in the US and we want to buy the US stock market, capital comes out of the Japanese yen. 0.3% doesn't necessarily pay the bills these days. And the stock market goes up and the US dollar against the Japanese yen goes up as capital goes out of the yen into the dollar. Now, when things start to look bad, capital comes back out of the US stock markets. We sell our stocks and we repatriate our capital from dollars back into yen. So when the Dow goes down, the dollar yen goes down. So if you're trying to guess which way the stock market's going to go, the dollar yen may be your answer. If we break above this 100 figure, it's amazing, right? I just noticed this. I should know these things, right? There's a 100 figure that are very significant highs. 99.73 was a high on October 28th. Then we're looking at 99.63 on November 3rd. Today we hit highs at 99.72, but 100 is a big level. Look at the former lows, by the way. These spike lows at 99.25 on October 16th. We failed long candlestick wick, but before that we stayed above 100. Point being is, I think if we break above 100, well, we had a recent swing high of 103.05 on October 14th, which is also a 61.8% Fibonacci level and also a downtrending resistance. So I think if dollar yen breaks above 100, it could go to 103. Well, if I think dollar yen breaks out, I most certainly must think the Dow Jones Industrial Average breaks out, right? And we see right now this triangle that is forming is right near the 38.2% Fibonacci level. The 50% Fibonacci level, which by the way is the highs of October 14th, is around 98.93. We'll call it 9,900. It's a 50% Fibonacci level. So I think if the dollar yen breaks out and the Dow breaks out, we're 94.59 on futures, indicating a pretty strong clip, overnight. I think we could see a move from 94 to 99. That's another 500 points, not too bad. At least 500 points. 61.8% is a lot higher. That's up at about 103. I'm sorry, 10,350. But 10,000 is a big number in the Dow. So I think looking at these two charts, it's pretty amazing. Pretty amazing how these correlations exist. It's not an accident. And I think if you're trading the equity markets, use the dollar yen to look for confirmation. If you're trading the dollar yen, well, we want to watch the Dow Jones Industrial Average. These are tools that the market gives us. Doesn't always work, but it's beautiful when it does. By the way, if there's any questions, do not hesitate to chat them in. Let's take a look at some currency pairs. Let's take a look at the cable dollar and the cable yen. I want to show you a cable dollar without all my lines. Let's take a look at a little bit of a bigger picture first. I love it. I love this stuff. I haven't slept since 2004, but who needs sleep? The markets are open, right? We'll sleep on Saturdays. All right, pound dollar. I've been glued to the markets lately. I can't get enough of it. Downtrending long-term resistance around 177.75. There's always something new. Former lows, well, we have around 174.27. Why not? Draw your Fibonacci lines from the highs going to 188, 186.67, September 25th. Drag them on down to what we knew were the lows. Let's look for some similarities here. This is a daily chart, pound dollar. What really sticks out? Look at the former lows over here. 174.45, September 11th of this year. That was a big day. 61.8% Fibonacci level also intersects with that. And if it takes some time, this downtrending resistance, which is currently at 178 may be down to the 174 level. I think pound dollar could have an extended move higher, maybe as high as 174, 75, 76. We're at 159.37 now. So you can see a real rally in the pound dollar. Remember that euro pound chart? Remember how strong that was? That shows a lot of it was created from euro strength, but a lot of it was pound weakness. Let's get through these rate cuts in the UK. Maybe we'll see a little bit more optimism return to the market. Maybe the dollar will really start to sell off. Now, is a correlation applying to the cable yen as well? What about the S&P 500? It's a great question. To be honest, I don't know. I would probably say not as much. Now, when dollar yen goes up, cable yen goes up. That's for sure. But the dollar doesn't always go up at the same amount as the pound does. I mean, after all, our cable yen chart is the mathematics if you were to put together the dollar yen and the cable and the pound dollar. I forget exactly how it's done, but if you divide one against the other, if you divide the pound dollar by the dollar yen or vice versa, you should actually get the price of what the cable yen is right now. Somebody who's better at math than me could probably figure it out really quickly. So, but point being is that, yes, dollar yen can go up, but that does not necessarily mean a cable yen is going to go up, especially if the British pound goes down. S&P 500, well, S&P 500 I think is a more refined look at the market. The Dow Jones Industrial Average are the 30 largest companies out there, but the S&P 500 includes a lot of more speculative companies, high tech, healthcare, etc. So the S&P 500, I would say, is a little bit more of a volatile instrument than the Dow Jones Industrial Average. Dow Jones Industrial Average is Ford, General Electric. I think Microsoft's in the Dow, right? But the S&P 500 could be Google, and these other Apple, which is considered a little bit more volatile. Do really very well under good circumstances, very poorly under bad circumstances. So to answer your question, yeah, I'm sure there is a correlation. If you have access to these different charts, put them together. Compare the dates. Look at the significant highs and lows and what dates those lows were and highs were achieved at. Pound dollar, aren't the rate cuts going to drive it lower? It's a great question. I think so. I think the anticipation of higher or lower rates is certainly the primary driver of the foreign exchange market, and I think it still is. But I think what we're seeing lately, with the Aussie and Kiwi going up in light of rate cuts, and the pound, and not so much the pound, but the euro going up in expectation of rate cuts, is not that at all. It is because the dollar and the yen, their trends were so strong for so long that this is a natural pullback. If we're looking at the bottoms, they call it a dead cat bounce. I don't believe that the Aussie dollar and Kiwi dollar and Aussie and a Kiwi yen continue to go up. I think long term they go down. So I think these rallies, let them occur, but I think they represent, could be a very interesting trade in the future to sell Aussie, sell Kiwis, and buy these lower yielding currencies. Let's look at cable yen. Cable yen, just to demonstrate where we were. We're looking back to July. July was not that long ago. A lot of baseball teams are still in contention for the World Series. That wasn't that long ago. July, cable yen, I should say, was near 215, 216. We're at 158 now, but that's after coming off the lows of 139. We went from 216 to 139, 7,500 pips. Cable yen, July, August, September, October, November, 4 months, 7,000 pips. There was a week, 2 weeks ago, I believe, cable yen went down, averaged 1,000 pip move every day. That is certainly not the norm. Now look at it, zooming in on daily chart. Look at this. We hit a high of 179.15 on October 20th. October 20th to October 24th, 4 trading days. In 4 trading days, we went from 179 to 139. 4,000 pips in 4 trading days. That's what I was talking about. 1,000 pips a day. Imagine selling one mini lot. You open up a $300 mini account. You sell a short £1 yen mini lots. You take a $300 mini account. Let's say you go on vacation for 4 days. You come back, if your $300 mini account is now worth $4,000. Of course, if we're fantasizing, we don't say a mini lot. We say, well, if I was going to sell short, I'd sell short one standard lot. So my $2,000 standard account lot is now worth $40,000. That was the last week in October. Was it the last week? Yeah, that was the last week in October. Will you say failure of the 15 cooling off system on the Aussie day is exceptional? It's not. It's a great question. It's not. I would say the majority of the time. I would venture to say, now I have not done statistical tests because there's a little bit of interpretation. It's not something you can very easily back test because sometimes, the market will break out with 3 candlesticks. Sometimes it'll retrace. So I would say 65, 70% of the time, if I had to guess, that I would say it works. I would say majority of the time it works. So today's failure, yes, it's not, in the norm. It's not very, very unlikely, but I think better yet, my point, I guess, is that it really demonstrates that when there's an underlying force in the market, our strategies, they'll work if they're going in the same direction as the trend. I don't mean it all to glamorize, by the way, the moves, the 4 1,000-point moves in the cable. Not my intention at all, but more to simply demonstrate it's something that's very, very much out of the norm. I really would love to find that the last day that the pound yen had 4 days an average of 1,000 pips to down. So I don't, mean to glamorize it. I certainly did not have a trade, in to take advantage of that big move. I was, in and out of the market. I certainly did not think it was going to go down all the way. But again, it's not to glamorize at all, how much money you can make, but just more to demonstrate how unusual the last week of October was. And we all know Octobers are usually pretty horrible weeks for the equity markets. So we can expect big moves in FX markets as well. But that is, again, that's the 15-minute cooling off period strategy. That's what I call it. And essentially what you do, again, is you measure the high and low of the market as it's able to achieve during the first 15 minutes after an economic release. It's got to be a significant number, though. I would not, plot it necessarily on initial claims, initial jobless claims. But central bank meetings, non-farm payroll, GDP, CPI, the big numbers, the Tankin, the zoo number, these big class 1 numbers, so to speak, the big guys out there, you can use it very, very much. Incidentally, by the way, at my site, I'll give you the address here. It's www.forexlounge.com. We host live trading sessions over 40 hours per week, and we apply that strategy to all the different releases, the big releases, and we actually give trade signals. But with that said, I do want to thank everyone very, very much for joining us. It's really been a fantastic webinar. Please see FX Street's calendar. I'll be on a little bit later on this month with a slew of more additional webinars. Thank you very much, FX Street. What a wonderful host. Again, contact me at my website, www.forexlounge.com, with any questions. We thank you very much for joining us. We wish you a great day. All profitable trades.